Hey guys, it's Max Convexity here. Hope everyone's having a great afternoon. Let's take a look at these new Defiance funds that are coming out that are using the zero DTE options. They're actually not using zero DTE, but they're using short, near-dated options. There'll be 1 or 2 or 3 day. It looks like these funds don't. These funds are trading on ETFs. The ETFs are the oil one, which is USO, the gold ETF, which is GLD. There's a silver, which is SLV, and the bonds is TLT. So those are the ETFs, and I don't believe any of these ETFs truly have dailies, have 5-day-a-week expiration, 5-day-of-the-week expirations. It looks like these expire on Wednesdays and Fridays, but still, they're going to be 2 or 3 day at the most. All right, so, I always talk about daily options so much, but the reason I like them so much is because you get more buffer. They're more conservative. You get more, it's more efficient at capturing extrinsic premium, and the extrinsic premium is what gives you the buffer against the downside. Now, it is true that a monthly option will bring in more money because monthly options go for more money, but you do the daily more often and you make up for it with volume. So even though the premiums look bigger in the monthly options, they aren't when you factor in that you do it more often. So yeah, these might be return monsters. I don't know. I make a few projections later. I mean, the big reason why I like these is because of the diversification factor. Because as you know, I'm obsessed with the covered call strategy, and any covered call strategy is better than no covered call strategy because any covered call strategy is monetizing options being generally overpriced, and that's a good business to be in. But you have to have some kind of correlation to some kind of something, on the ones that I talk about every day, the correlation is to an index where they're, basically correlated to the NASDAQ or the SPX. This is cool because it's correlated to things that are correlated, that aren't correlated as much to the NASDAQ and SPX. You don't get too much diversity going from, JEPQ to QYLD. I mean, a lot of these funds have the same 10 or 20 stocks. I mean, it seems like to me, the ones I've been covering so far. Now, these new funds bringing on gold and oil and silver, this would also serve to be an inflation hedge. Because what do we know about these high-yield funds? We know that if the parent asset is up like a crazy amount, these high-yield funds will be up a crazy amount too. But if you look at it and you think about silver or gold, if you think about it, if our economy in the U.S. ever just goes really down the tubes bad, silver and gold and probably oil too will all be pretty high. They'll probably all be up 500% or something. And it won't be a great time for anything else. But if you have these funds, even if they do kind of bad in the years when a bull market's on, these funds might be good hedges. Or I think they would be good hedges. Now, it's true, it's true if you just knew gold was going to be up 1,000%, it'd be better to just get that rather than do a covered call strategy and only be up a fraction of that. But still, my point is, these will monetize these gigantic moves. You can see it happening in some of the yield max ETFs now and how high they are above 20. And they've just been out a few months, but it's because the parents have been just going crazy in this last little bull rally. So the other cool thing about this is, okay, so gold and oil are just kind of are less correlated to the SPY, but they still kind of move in the same general direction. But TLT, which is bonds, is actually inversely correlated. So in finance, correlation can measure the movement of the stock with the movement of the benchmark. And usually when people mention correlation, they mean to the SPY. That's almost what it implies, kind of. So correlation and diversification they're similar concepts. There are certain types of risk that can be mitigated by investing in assets that are not correlated. Here's an important thing, and I've heard this one a jillion times. Correlation measures association, but does not show if X causes or Y, if X causes Y or vice versa, or if the association is caused by a third factor. In other words, that's the old saying that people say, correlation is not causation. So a perfect positive correlation would be like the triple Qs have a perfect positive correlation to the NDX. So they're both based on the same index. A perfect negative correlation would be the QQQs have a perfect negative correlation with the QQQ put option. And one's up, the other one's down, and vice versa in a perfect amount. Or with a short position. You could also say a short position in the QQQs would be perfectly inversely correlated with the NDX. Correlation is most important in relation to a diversified portfolio. Investors who want to mitigate risk can do it by getting non-correlated assets. This is often a good approach to take when you're investing across asset classes and you choose classes of assets that are either inversely correlated or not highly correlated to each other. Stocks, bonds, precious metal, real estate, crypto, commodities. All right, I pulled recent correlation figures for the SPY and some other ETFs. So the SPY to the Qs are pretty highly correlated. It's 93%, okay? The SPY to FEPI, FEPI, is a little bit less so correlated. It's only 81%, and the least correlated is the SPY to the Russell. But I just wanted to show that when you're just switching between different types of funds, they're all still fairly correlated. So when you go to whole different asset classes, like here's oil, it's only 37%. Silver is only 23%, correlated. Gold is only 5%. It's basically not correlated at all. And I don't know, these really aren't percents. I don't think that's the right way to say it, but that's just the way I'm thinking of it. Now, Treasury bonds are interesting because the TLT ETF is actually inversely correlated, but it's not superly inversely correlated. It's only 34%, but it can serve as a good hedge. And of course, that's where the 60-40 portfolio comes from. 60s stocks, which would be like the spider, and then 40 is bonds, which would be the TLT. You could do a real simple 60-40 portfolio with the SPY and the TLT. Not financial advice, but yeah, you just don't get too much true diversification until you get into different asset classes. Okay, and while I was in pulling correlations, I pulled some correlations of some ones that are inversely correlated. And the ones that are highly inversely correlated, especially in leverage, like SQQQ, those are the eroders and decayers. And I just like to pull them up and check on them every once in a while. But you can see these are the ones that bleed money out. And I'm not saying, I know there's some people that like CYA, and CYA can work, short-term protection, these have a place. But if you hold them for any period of time, mathematically they'll erode. I'm not saying they aren't great funds, but these are the eroders, unlike the the covered call funds, because if you hold them, they're actually earning extrinsic premium, so they're doing the opposite of these funds. All right, so I did some back test here, and here I'll just show you right here. The most promising one, well, let's look at the slide deck first. In the slides, they all had a nice edge to them. Now, they're going to sell short-term puts, so I did 3 days. But I also tested 2 day and 1 day, and they were profitable across all 3 days. I tested 60 delta, 65 delta, 50. They were hugely profitable to sell puts on other indexes besides the NASDAQ and the and the SPX. I was a little surprised they'd be this profitable in commodities, but it works the same way. You win, let's see, 63% of your time, you win 64% that time, 63%, and 63%. but you have pretty good edge in all of these. So I ran some numbers. I got in my Tasty Trade, and I saw what they would charge me to hold a short put in those and all those different things. And then I tried to compare it with the whole what it cost to hold a short put in NASDAQ compared to what you get, and then try to equate it to a potential, yield that it might have. So I don't know. These are guesses at best, but I'm saying 75 for oil for the USO one. I'm saying probably 25 or so for gold. I'm saying that's the least. That's the least of all of them. Jackson. So I'm saying gold is the least. I'd say around 25. I just approximate these numbers. Silver maybe around 45, and bonds maybe around 30. What else I think is interesting about this is Zega is the sub-advisor on this. And Zega also is the advisor on TRES. They have this bond fund now, and I believe they sub-advise on another bond fund too. I think it's getting real incestuous with Zega in their bond funds. But I'm more for it. It's more, diversities. Diversity's our strength. Here comes the moment. So Jackson's probably going to bark. But yeah, diversity's our strength, and I am pumped up about this. I'm all about it. Remember, as always, this is not financial advice, but it is fun and entertainment. It's fun for me to do it. I hope it's fun for you guys to listen. Leave me a comment and tell me your thoughts on diversification and asset correlation and all these things. And what do you think about these new commodity funds? Are you guys going to be getting them, or are you going to take a pass? All right. You have a good day.